Street Week with Louis Rukeyser is made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you. By The Travelers, over 30 million Americans benefit from our insurance, investment services, and managed health care. The Travelers, America's umbrella. By MFS. MFS, helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. We believe the most important thing we earn is your trust. Prudential Securities. Produced Friday, August 27. Guest host, Mary Farrell. Our panelists are Michael Holland, Bernadette Murphy, and Robert Stovall. Tonight's special guest is William H. Miller III, President, Legg Mason Fund Advisor.
Good evening. I'm Mary Farrell. Louis Rukeyser is on vacation, so I'll be your host tonight. Welcome. Well, this was the week when NASA's billion-dollar baby never phoned home. The Mars Observer, the first U.S. mission to the Red Planet in 17 years, fell silent just days from reaching its destination. And now Mom and Dad are worried that Junior may be lost, kidnapped, or worse. There hasn't been a successful landing on Mars since our Viking spacecraft in 1976, which, incidentally, photographed a Martian rock formation in the shape of a human face, longer than the Golden Gate Bridge and as tall as the World Trade Center. Maybe Mom and Dad should be worried. But while little green men may not be welcomed in NASA, they would feel right at home in Wall Street as the Dow and the broader markets hit numbers this past week that were out of this world. The Dow recorded its 21st record high of the year on Wednesday and came within just 50 points of 3,700. We like green. Green is good. Car makers got a little more pocket change as sales were up for the first half of August, while the grass grew greener for existing home sales, which rose for the fourth consecutive month in July, helped by the lowest mortgage rates since 1968. Consumer sentiment and expectations rose slightly, though big-ticket factory items have been grounded for the fifth straight month. And banks continue to be stingy with their money, prompting more small businesses to be stingy on hiring. We, tonight, will talk with a man responsible for investing almost $1.5 billion of that green stuff. But first, let's check out the other news in the Emerald City in the week just past. The Dow Jones Industrial Average recorded its 20th and 21st record highs on Tuesday and Wednesday, and after slight declines yesterday and today, managed a weekly gain of 25 points to close at 3640.63. While the broader markets all hit records during the week, only the Amex eked out another one today. None of this green activity managed to arouse even one of our chief elves, who still remain at a slightly bullish +3. Bonds fell today, but are up to record levels for the week, while precious metal lost some of their lusters. And for those of you men who think women go for personality, know that a survey of 500 women by Johnston and Murphy found that their idea of Mr. Right is the one who wears loafers or sneakers, and 12% have nixed a date because of a man's shoes. Bernadette Murphy, does this market have another leg to go up, or are we just waiting for the other shoe to drop?
Mary, I think the market's going higher. Now, there could be some problems if interest rates went up, but we don't see that happening. Earnings have been holding together. There's always the fear of the unexpected. That's a problem that we may have to face sometime in the future, but it isn't here right now. So the risks are there, but if you keep a diversified portfolio, I think we're all right.
Bernadette, even though the Dow is up 10%, the broader S&P index is up less than 6%. What's going on within that market? What groups look good, what don't?
Well, the S&P has finally now moved on to new high territory, and I think it will catch up to the move in the Dow. I personally still tend to favor the industrial sector of the market. And if you break the market into consumer, industrial, and financial, I'd have to go with the industrial and with the financial.
Bob, we've had one positive input here. Where do you weigh in?
Weigh in's a good word in my case, I guess, Mary. But by every historical precedent, the market's been overpriced or dangerous for months and months now. But I think at some risk, I'll say things look a little different now. The main difference is time. We have low interest rates, low inflation, and because the administration and the Congress are holding back the economy for all they're worth and other things that are happening, we have a very slow recovery internationally, actually, which gives the market time for this rotating readjustment. So I don't think we're going to see a waterfall of all the prices going down and a 10 or 15% drop. Rather, we'll see one group after the other correct, and I think we'll see 3,700 by the end of next month and maybe 3,800 by the end of the year.
Well, we've had two incredibly positive market watchers here. I'm afraid to ask. Mike Holland, what do you see?
You're looking for a sell signal, Mary. You've got it. I agree with the two of them. And I think the major market move is still in a bull phase. I think the major companies like GM and so on, which have done all of the right things, continue to be favored by the market, and I think the market's going to move higher over the near term.
Are there any particular sectors of the market? What do small stocks look versus large stocks?
That's a very good point. Not too many people have talked about that recently, Mary. I think the small stock part of the market is very, very attractive here. I think mutual funds, which emphasize those, are very attractive and should be looked at by people right now.
Okay, and the Bundesbank didn't lower rates like everyone expected.
Right.
What does that look like? Is that going to be a negative for our market?
No, I think, as Bob was talking about it, all that's going to do is slow down the economic recovery, which is inexorable, but it's going to be very slow and happening in Europe, and it will keep our recovery very slow and keep interest rates down and keep stocks up.
So what does that mean for European stocks? How do they look here?
The Bundesbank's action actually caused a number of the stock markets in Europe to go even higher. Mary, I think that the recovery over there will be slower, longer delayed, but when it comes, it'll very much reflect what's gone on in the U.S. in the last few years. I think those stocks go much higher. I would continue to look to the European country funds, which are traded on the New York Stock Exchange, as very attractive vehicles.
In any event, panelists, it's time now to make our viewers the object of green envy by answering their questions. Bernadette Murphy, Justin West of Peoria, Illinois, is curious about the large number of initial public offerings that have been entering the market. He wants to know how IPOs are issued and how can the small investor get in on the action?
Offerings are made through syndicates of underwriters, and you can contact the lead underwriter and get a copy of the prospectus. If you're an active account with one of the underwriting firms, you may very well get an allocation. If you're inactive and you receive an allocation, you may want to draw back because that might mean that demand is not quite what it should be. So buyer beware. If you really like a company, then I'd follow it in the aftermarket, and there are frequently buying opportunities in new issues.
Sounds like good advice. Bob Stovall, as a grandfather, you should be just the one to help Nathan Sinaway of East Brunswick, New Jersey, whose letter reads, I have recently become a grandfather for the first time, and I want to help my son and his wife prepare for the college education of this budding genius. How can I maximize growth and minimize tax costs, whether to myself, my son, or my granddaughter, and be sure that this money is spent on her education and not some other purpose?
Now, Mary, whatever's left of my youth image has been destroyed, but
I apologize.
I do have 3 grandchildren and 4 foster grandchildren, and I've thought about this. There are 2 ways that I know about. One is the U.S. government has a EE savings bond, which is free of tax in terms of the income if it's earmarked for tuition payments only, and you make out the account in the name of the son, Nathan's son, as custodian for the granddaughter. And as long as he doesn't make over $65,000 a year, the tax-free proviso holds. If he makes more, he has to pay some tax. As far as the growth aspect, there's one mutual fund family called 20th Century Funds out in Kansas City that have the 20th Century Gift Trust. This is irrevocable. You pick the beneficiary, you pick the time frame, you can't suggest the investments. But you put the money there, and say 18 years from now, little granddaughter is ready to go off to the Wharton School, and off you go.
Sounds good. Mike Holland, how would you respond to Robert Kunkel of Sedona, Arizona, who writes as follows, I recently read that digging up information about ancestors, one's own or someone else's, has become the nation's 3rd favorite pastime, right behind stamp and coin collecting. Can you lay to rest my curiosity about investment opportunities in genealogy? It haunts me to know if I stand a ghost of a chance of making a buck out of unearthing information about our past.
He's looking for a grave answer. Mary, there aren't any companies I'm aware of that are publicly traded in the U.S. that specialize in this area. H&R Block, for example, has a small subsidiary operation, CompuServe, which has a large database, but it's a very small part of their earnings. GE, in fact, has a very small operation in this area. You'd really have to stretch to find a way to play this. The Mormons, in fact, in Salt Lake City have the largest database in the world for genealogy. There's a wonderful bank out there, Zions Utah Bank, which is very attractive, but there's no easy way to make a killing for this investment plot.
And we can bank on it. Okay. Now, if your finances have been in the dead zone lately and your broker has been leading you to a dead end, don't take it lying down. Just throw the book at him or her and send your ghostliest money questions to us here at Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, a value investor with a successful track record managing mutual funds, let's take a look at his rules of investing that have made him, in the eyes of his clients, the value man. As a value investor, our guest scopes for companies that can be bought at large discounts from their current estimated worth. They must generate excess cash, while management keeps shareholders abreast of all the comings and goings within the organization. He ignores cyclical stocks, or those companies that follow along with the roller coaster ride of the economy. Our guest says he'll sell when any one of three events occurs: when he finds a flaw in the company, when his mutual funds are fully invested and he needs to make room for a better bargain, or when a company reaches its fair market value. Is it really all as simple as it seems? And if so, how can we make a buck or two ourselves? For some thoughts on that, let's go over now and meet tonight's special guest, William H. Miller III. Hello, Bill. Welcome to Wall Street Week.
Thank you.
William Miller is up to his neck in funding, mutual funds, that is. As president of Legg Mason Fund Advisor, he heads the investment division of three successful equity mutual funds: Legg Mason Value Trust, Total Return Trust, and Special Investment Trust, which has outperformed the market in each of the last 5 years. He's responsible for over $1.5 billion of other people's money. Prior to managing the Legg Mason funds, Mr. Miller was the firm's director of research. Bill, with the market as high as it is, are you having trouble finding stocks you like?
No, actually, Mary, there's a lot of value in this market. This isn't like 1987 where we had a hard time finding value. I think there are two things that worry people about the market. The first is people have a tendency to think dramatically and not quantitatively. So what they do is they reason, gee, rates are down a lot and stocks are up a lot, so perhaps they're too high. And the second thing people do is they look back at historical data. And they see that when PE ratios have gotten into the high teens, as they are now, and price-to-book value ratios are over 2, as they are now, the market has historically been weak, so they're concerned that that may happen again. But what we're finding is, and in fact running some screens on the market today, there are over 900 companies with market values greater than $1 billion. And there are 90 companies that have PE ratios under 10 in that category. And if you expand that to companies with market capitalizations of 100 million or greater, then the number expands to over 350 companies with single-digit PE ratios.
So you're saying for a real value player, the market is not nearly as important as your ability to find stocks that
Sure,
show the right...
because you don't buy the market. You buy a portfolio of stocks one at a time.
What particularly do you look for in a stock?
Well, we look for companies that we can buy at large discounts to what they're worth. The trick is to figure out what they're worth. What we do is we try and assess the economic value of the enterprise, and we do that by projecting future earnings and especially future free cash flows, then using a discount rate to try and find a present value. When the companies trade at large discounts to that, we can look up the price every day in the paper, then we do much more work, and we try and find two other things. Does the management care about the owners of the business, and are the earnings really free cash?
When you talk about earnings, a lot of people associate earnings with growth, and typically there's been a debate between value versus growth. I think value's outperformed this year. Does your definition of value necessarily preclude growth companies?
Well, we don't believe there's any difference between value and growth. Value is a comparison of one thing to another, and growth is a time series. So our question is really, where is the value in the market? Is it in companies that are traditionally called growth companies, or is it in companies that are cyclical companies? Right now, we're finding it more in some of the growth companies, but we're finding enough things at low PE ratios to really have a portfolio that looks a lot like traditional value.
What kinds of things are you finding that look like good value today?
Well, financial services broadly defined we think are outstanding value. Banks, brokerage firms, thrifts, some insurance companies. We can buy, Citibank, for example, trades at around $33. In 1929, it was $28. That's not much of a return for the last 60 some odd years. But we can get Citibank, Bank of America, Continental Bank below book value. Those are all very cheap stocks.
Are there any other groups, drug companies, which used to be high-flying growth stocks, now seem to have fallen into the value category? Do they look good to you?
Some do. We're spending some more time on biotechnology than on traditional drug stocks. Many value investors say, gee, they don't understand biotech, so we're finding that the growth people have left that area and the momentum people have left that area, and so they've left it and neglected it. So, for example, Amgen right now, which is in the mid-30s, we think is worth in the mid to high 40s. Biogen, which is in the low 30s, we can value that conservatively in the high 40s.
When you look for value companies,